Welcome to another video. This is my review of the market activity and my own trading for the fifth and final week of January 2025. It was a relatively quiet week. In my forecast ahead of this trading week, I had mentioned that I did not expect much from it. It was a generally low probability week in terms of the number of days I anticipated that I might get a trading setup on. And that eventually turned out to be the case. With the closure of last week's candle, the January candle also closed, and you can see that it essentially was a doji candle that went nowhere, closed pretty much where it opened. Neither the bulls nor the bears won in the month of January. Now, that indecision candle is relevant going into next month, but I'll discuss that in my forecast video. What I want to take a look at is what happened during the final week. So if I just go down to the weekly and what I did in my own trading. Now we can see that the week was a largely bearish week, but the manner in which this candle printed is very interesting. If we go down to the daily, and the reason that I anticipated this week being a lower probability week was that there was FOMC on Wednesday during the week. On Thursday, there was Euro rate announcement as well. So there were major news releases that tend to stall the market before they come out and that throw the market into a frenzy when they do come out. I did not anticipate or have any trading setups on the euro. I did on the pound. And so we'll analyze the week's price action on the pound. However, this week I took just one trade and it ended up being a loss. Now, I had two trading opportunities according to my system, three that I was looking at. One of them I took ended in a loss. The other one, which would have been a win, I was unable to take because at the time when the setup printed, I was in a meeting and I didn't have my laptop, I could not use my phone at the exact time when the setup was printing. The third and the final, trading opportunity that I anticipated actually presented the setup, printed and played out. But it played out in the final 2 hours of the trading week, Friday, as after the end of London kill zone, when you would not expect any volatility and you just expect the market to basically die down. It actually played out, and I'll show all of that. So this is Friday, Thursday, Wednesday, Tuesday, Monday, right? So we can see here that this fair value gap was created. This daily fair value gap was created here. This was the trading opportunity that I missed. Let me go to the one that I took first of all, and then and that was on the pound, and then we'll look at the two opportunities, one that I missed and the other one that just happened at a very, very strange time. So we are on the pound dollar now, and this is what we see going into the week. This fair value gap had already printed, this daily fair value gap that you can see here. Let me use a line to denote when price traded into that fair value gap so that we can see it when we go down to the lower time frames. What happened was that this was Monday's candle. Monday's candle created this daily, completed the formation of this daily fair value gap. And so on Tuesday, ahead of FOMC on Wednesday, I was anticipating price to take out Monday's low, dip into the fair value gap, give me a bullish rejection on the lower time frame for me to take a long trade, targeting 3R. All of those things happened except the expansion away from my entry that I was hoping for. So what happened was that on Monday, so this was the bit of price action, we can see the trade setup right there, and then how it ended in a loss. So this was Tuesday's price action. We can see this beautiful low right here. This was Tuesday's price action. Asia consolidated. London traded below Asia, created relatively equal lows with Monday's low, did not engulf the candle, so there was no trade, did not even tap into it. My alert was not triggered. And so that gave me even more confidence going into the trade. Price traded away from that level, solidifying the relatively equal lows. And then during New York session, price traded through both lows into the daily fair value gap and printed this beautiful 15-minute hammer candle that we see right here. So this candle was my entry. I took the trade, put my stop below the low, targeting about 3 hour, but you can see that price just danced around, consolidated, eventually took me out and consolidated the rest of the day. Now, this is, I wouldn't say typical, but can reasonably be expected when the following day is FOMC, because sometimes what happens is that when the market is gearing up for FOMC, it goes quiet, not just the sessions before, but sometimes even up to a whole day before. What was underwhelming, however, is that when FOMC would eventually print, on Wednesday, this was the FOMC this candle on 2 p.m. New York time, Wednesday, 29th January. I was expecting a huge, like 150 people move, unidirectional move, and FOMC just stalled, didn't really do anything, and then, you know, just danced and continued consolidating. So we can see that the price action was terrible. Pretty, pretty, pretty lame price action that you wouldn't really want to be a part of. But let's go back to the daily time frame. Now, with the end of Wednesday's candle, a daily fair value gap was formed. All right, so this was the daily fair value gap that formed. So this was Monday's candle, right? Monday, Tuesday, Wednesday candle. With Wednesday's candle's closure, a daily fair value gap had been formed. So I identified that, and since at this time the momentum seemed to be pushing to the downside to target some internal liquidity within this range, the range that is the range from this low to this high, from this low to this high. After, Monday's candle created this doji, Tuesday's candle expanded lower, Wednesday's candle expanded lower, but it was eventually still a doji and created a fair value gap. It suggests to you that price intends to, at least that the retracement, three candles going in the opposite direction, tells you that the retracement has started in earnest, and you can reasonably expect price to trade at least to the 50% of the range. So with the creation of this bearish order flow, I was looking to take a trade that would be if Thursday traded, into my point of interest. Let me show where it happened and why I was unable to capitalize on this trade. So this was what happened. We can see that on Thursday, price actually started trading bearishly, seemingly far away from the point of entry. Let me go down to the lower time frame so you can see how Thursday's price action actually unfolded. Now, this was Thursday's price action. I have highlighted what would have been the trade. You can see that the 3 hour trade played out perfectly, but I did not capitalize on this opportunity. Now, what you can see is that on Thursday, Asia session consolidated, London session traded bearishly, kept going lower. And so it was not until New York, kill zone. And at this point, when price is trading at this low, you don't really think that price is going to trade all the way back up here during New York session, then give you an entry to go long, then come back down to the lows. But such is the nature of the market when news releases are expected. This huge candle was the candle that printed when the European bank interest rate was announced. So what happened was that price shot up into the daily fair value gap. Now at this point, my phone was in my pocket. I saw the alert, I saw the notification, but unfortunately I was not in a position where I could, bring out my setup and start executing trades, on my account. Now this is what this trade would have looked like on the 5 minute time frame. So when a setup is catalyzed by a news release, a lot of the time, if you wait for full 15-minute candle closures, you might end up missing out on the trade altogether because, or getting a terrible risk to reward because there's a lot of volatility at times like that. So what I do, how I would have taken this trade is when price shot up into the daily fair value gap and completely, overlapped it, overshot it. This was the point where my alert was triggered. On this 5 minutes, huge candle, because it's difficult to get engulfing candles at times like that. The reason is the sheer volatility of the candles. Imagine if you had to wait for this entire candle to be engulfed. By that point, like 70% of the range that you are expected to catch has already been fulfilled. So on the 5 minutes time frame, when this huge bearish candle printed, and I like the fact that it continued to the upside, then closed near the bottom. This would have been sufficient for me to take an entry. That's why you can see that my risk reward short tool, is here. This would have been entry. You see that it is still a 21 pip stop loss. Very reasonable, well within my parameters. So this would have been the entry, stop goes above the high, target 3R. And that same day, okay, well, not the same day. I think yeah, during Asia session the following day, 3R was delivered. Now, let me go to the final trade for the week, which was odd. So this was not a missed opportunity. It was not an opportunity, but it was price doing what I thought price was going to do, just at a time when it was practically impossible to expect price to do it or to capitalize on it. And I hope you can already see what I'm talking about. It is this Friday candle. Now look at this abominable Friday candle. That does not make any sense. And I'll tell you why. So with Thursday's candle, and this setup was so beautiful, I really hoped I would be able to take it. You can see that same fair value gap that was created by Wednesday's candle on New Zealand dollar, price did not trade into it. So the setup was still valid on New Zealand dollar. Now see where Friday's candle opened. You might be thinking that price traded all the way up into the daily fair value gap, then traded back down. Maybe London session, traded bullishly. Then during New York session, we got the reversal and then it came back down to the lows. Nope, no such thing. Let me show you what actually happened. So this was what happened on Friday. On Friday, now, if you look at my indicator, it shows you the different kill zones and what happened during those times. You can see that on Friday, this was Asia's range. Asia traded bullishly. So, and then before London, up till London kill zone, price kept trading bullishly. Now you can imagine at this point, this was the start of London kill zone, right? London session hadn't even opened. At this point, I was thinking, okay, price is pretty close to my point of interest, which was here. So I might reasonably expect to get a setup, during London. And then if price trades into it and then gives me, a bearish engulfing candle, I take the short trade and I expect the distribution to occur during New York session. No such thing. You see that price just got here and then London started going back to the downside. So at this point, when New York kill zone came around, now the thing about Fridays is by the time you're getting to London close kill zone, the volatility begins to die down. You don't really expect anything to happen anymore. Any trade, Friday trades usually set up and play out between London and New York open, right? Such that the latest you can reasonably expect to take a trade on Friday is New York very early during New York open, and then the rest of New York kill zone itself, this purple box over here, will present the expansion. So if you see New York, the entirety of New York kill zone consolidating, you're pretty much expecting the rest of that Friday to just die down and do nothing. This was London close kill zone. Now, there was no news, nothing. I think there was one CB consumer confidence something, but it wasn't London close kill zone. It was a New York. It was a New York bit of news. I think this scandal or something. Very, very benign news release. So this volatility is virtually unaccounted for, unexplainable. Price ran, and this is London close kill zone. So London close kill zone on Friday. You're not expecting anything. Price ran through it out at the end of London kill zone, then traded lower. Look at this monstrous candle. Just look at this. How is price? Now, this is New Zealand dollar, by the way. A 34 pip move on New Zealand dollar is equivalent to about a 60 pip move on euro dollar or pound dollar. So that should tell you the sheer volume, the sheer range of this type of candle. You don't expect to see this on a Friday evening. So, yes, precisely what I was expecting, price trading to a daily fair value gap, expand away from it. It did it without giving me an opportunity to get in. So that's essentially what happened this week. That's how I traded. Closed the week 1 hour negative, but I'm proud of my trading in that I respected my rules. My actual trading performance was top notch. Didn't take any more losses than I needed to take. Respected risk, understood the market conditions, and was prepared for them. So that's what happened. That's January.